Hi, Charles Sizemore here. So today we're going to talk about dividend growth. As you guys know, well, you know my shtick. I like high yield, but high yield by itself is really not. That's not the end all be all for income investing, and it's for a couple reasons. So if you have a yield that's high today, let's see you're getting whatever, 8% yield, 10% yield. But let's say that it's not really growing. That yield is just, that's it. That's what you're getting. That may look great today, but over time, it's not going to keep up with inflation. Even if we have inflation at today's relatively muted levels of 2% a year, if you're talking about a time horizon of 20 or 30 years in retirement, that's just going to chip away. So even though that yield looks impressive today, you put $1 million into that, you're getting 80,000. That's not bad. But that 80,000 is not going to be worth nearly as much in 10 years and 20 years. So if you are wanting to build a durable income portfolio, that high yield by itself is just not enough. You also need dividend growth to keep up with inflation. But beyond that, high yields are almost always, well, I can't say almost always, but are generally a indication of financial distress. So you may be getting that, 8, 10, 12% yield today, but it may get slashed. The payout may get cut tomorrow. So it's not really going to do you a lot of good if you were anticipating making, whatever, 40,000, 80,000, whatever that number is off of that dividend stream, and then it gets cut in half or worse. That does often happen. Now, there are exceptions, of course. There are sectors that tend to be exclusively yield focused and have no real capital gains expectation. And that's fine. You can have some of those in your portfolio for sure. But if you are looking for that durable, that portfolio that's going to get you through the finish line in retirement, then you really need to focus more on growth than on yield. So today we're going to look at the Dividend Aristocrats. The Dividend Aristocrats, it's kind of a silly name, honestly, but these are companies in the S&P 500 that have raised their dividend for at least 25 consecutive years. That's a big deal. Think about the last 25 years. It's been really quite the roller coaster ride. We had the dot-com bubble and bust. We had the 2008 meltdown. We've had the coronavirus. We've had pretty much everything you could imagine under the sun. Any company that was able to maintain and raise its dividend every year throughout the last 25 years, that's a company that might be around for the next 25 years. That's a really nice way of looking at it. If they survive the past 25 years of utter chaos and manage to raise their dividend every year, I don't know what the future is going to throw at these companies that would prevent them from doing it going forward. For crying out loud, if the shutting down of the world economy from a once in a century pandemic didn't do it, I really don't know what will. So if you want good exposure to just blanket exposure to these dividend aristocrats, these blue chip companies that have managed to raise their dividend through thick and thin for multiple decades, one way to do that is to go with an ETF, the ProShares S&P 500 Dividend Aristocrat ETF. Ticker symbol, this is a cute one, NOBL, like noble, like nobility, because they're aristocrats. I know. That's actually a pretty good starting point. If you want just a core position of good dividend growers that you can sort of build a portfolio around, this isn't a bad way to start. Now, today I want to focus, though, on, by the way, let me back up for a second. The last stock that I looked, the last dividend stock that we looked at was a Realty Income, of course. Well, Realty Income is a proud member of the Dividend Aristocrat list. They have raised their dividend well in excess of the 25 minimum years to make that cut. Anyway, this week, I want to focus on one of the longest streaks, I guess you could say. There's several companies tied for first place in the Dividend Aristocrats for most consecutive years of dividend increases at 58 years. And the one I want to focus on today is the 3M company. Now, most people, ticker symbol MMM. Now, you're familiar with 3M. They make tape, for crying out loud. They make Post-it notes. They make assorted adhesives, glues, things like that. They make medical masks. They have a very kind of boring, not very exciting portfolio of products, but it's stuff it's brands you recognize, and it's stuff for which there really generally isn't a lot of competition. 3M's products are considered to be high quality. People go to them because they know they can trust them. And at the end of the day, it's Post-it notes, for crying out loud. I mean, there's not a lot of, this is pretty much a future-proof business. This is a business that hasn't changed a lot in decades. It's not likely to change much in the decades ahead. They're going to get more efficient at what they do. They'll come up with new products, variations on existing products. But at the end of the day, 20, 25 years from now, we're still going to need glue. We're still going to need adhesives. We're still going to need whatever specialty chemicals. We're going to need all the junk that these guys make, right? They've raised that dividend every year actually, let me back up again. Most people, I always like to throw this out there. Most people have no idea what 3M actually stands for. Why is it the letter M 3 times? Originally, it was Minnesota Mining and Manufacturing. Now, the company has very little to do with mining today, not even that much to do with manufacturing, but that is, that's its origins. So if you're wondering where the 3Ms come from, it's Minnesota Mining and Manufacturing. At any rate, 58 years is a really nice track record. It's unlikely that anybody would actually own this stock for 58 consecutive years. You'd have to buy it and, in your youth or early middle age in order to have it by the time you retire. That's really not likely for most people. So I would say, let's look at a shorter time horizon. Most people are retired for, let's just call it 20 years. You retire in your early 70s, maybe you clock out in your early 90s. That's a what I would consider a normal investing time horizon. So let's look at what 3M would have looked like if you owned it for the last 20 years. So today it pays a quarterly dividend of $1.48. Well, 20 years ago, it paid a quarterly dividend of 30 cents. So we've seen almost 400% growth in the dividend over the last 20 years. Now, we're not talking about the stock price at all. Let's just eliminate the stock price from the discussion right now. We're talking only about dividend income. The dividend payout, the amount of those quarterly dividend checks, that dollar amount of those dividend checks hitting your mailbox or hitting your bank account, well, more likely hitting your brokerage account, that's gone up by almost 400% over the last 20 years. That is well in excess of the rate of inflation. So if you bought this stock 20 years ago, planning to use it to get you through your golden years, you don't have to worry that your purchasing power would erode due to inflation. If anything, you actually got a little bit richer. Those dividend checks grew faster than the rate of inflation. Now, this is where it gets fun. I really like this analysis, yield on cost. So let's say you owned this stock 20 years ago. You bought it 20 years ago. You have all that dividend growth that's happened in the years since. What would be your yield on cost? What would be the dividend today relative to your original purchase price? It's not the yield you would achieve if you bought it today. Of course, this is the yield, that on that original investment. Well, in the case of 3M, it would be about 12%. So you're making, let's say you invested that marginal dollar into 3M 20 years ago. You're now making 12 cents a year in dividends alone, apart from any capital gains. That's great. I mean, if you build a portfolio of stocks like these, you will have no problem at all keeping up with inflation in retirement. Obviously, you don't want, this is a slow moving stock. This is not a stock that's going to make you wealthy, but it is a really nice sort of baseline income stock. At today's prices, it yields about 3%. That's not amazing by any stretch of the imagination, but it is significant. The 10-year U.S. Treasury only yields about 1.7. It's been fluctuating between 1.6 and 1.7 for the last week or two. So you're talking about a yield that's almost double what you're going to get in a 10-year bond. That's really not bad. In this environment, that's not bad. Plus, again, it's going to grow over time, or at least it certainly has over the last 58 years and counting. So as you know, in Green Zone Fortunes, in our monthly newsletter, and also in the Money and Market site, we do like to look at our stocks through a quantitative lens. We don't just pick stocks at random here, or find stocks that we find stocks that we're subjectively attached to. We actually do have formulas. We have a quantitative system that ranks the stock based on 6 primary categories. And then, of course, there's multiple subcategories under those 6. Well, let's go ahead and look at 3M based on that criteria. So overall, it rates a 61 out of 100. That's not bad. That's bullish territory. Anything over 60 is considered bullish, and we would expect, based on our historical analysis, that stocks that are rated 60 or higher should have returns roughly double that of the S&P 500 over the next 12 months. Doesn't always hold, but that's the average. Now, 61 out of 100, of course, isn't just this blockbuster score. We do have stocks on the list, obviously, in the 98, 99 range. But if you are looking for something that you can hold potentially for decades and not really worry that much about, that's this. I mean, a lot of our more highly rated stocks are stocks that you might want to hold for a year or two. They're more, short to medium term trades. They're not necessarily long-term buy and holds. The nice thing about 3M is that it's essentially timeless. It's a stock you can just sort of buy and hold, put in a drawer, and forget about for potentially decades while collecting that dividend check. Now let's dig a little bit deeper into it. So its highest rating is quality. And that's not surprising. Considering these guys have been around for decades and they are a well-known name, they're able to charge a premium for their products. You pay a premium for Post-it notes as opposed to generic sticky notes. You pay a premium for 3M branded medical mask as opposed to just some knockoff from a flea market. At the end of the day, you value your health. You want something with a good reputation. So that that decades of brand reputation there helps them charge a premium that translates into higher profits. It translates into higher return on investment assets, et cetera. It helps boost their rating here. Those quality scores take decades to achieve, and they can be, basically flushed down the toilet in an instant. But 3M's done a really good job of building that reputation, building that brand, and it shows today. It shows up in their quality score. The company also rates particularly high in volatility. Remember, a high volatility score means the stock has low volatility. We want low volatility stocks because over time, they tend to outperform high volatility stocks, and they also give you a lot less headache. So this is a little trick that Warren Buffett figured out years ago. The secret to Warren Buffett's success, it's not that he's just an amazing stock picker, although he is an amazing stock picker. The secret to his success over the last several decades was he used Berkshire Hathaway's insurance float money to buy a bunch of low volatility growth stocks and just let them run for decades. It worked. And you have seen a lot of, we've seen a lot of large investors copy Buffett's lead of buying up insurance companies and investing that float. You and I can't go buy an insurance company. We don't quite have that kind of capital or exposure, but we can buy low volatility stocks, particularly if they're dividend payers. We can buy these low volatility, high quality stocks and just let them run. Will it outperform next year? I don't know. But if you are looking for something to buy and hold for the long term while collecting these dividends it throws off, these are the things you should look for. You should look for that low volatility and high quality. Now, moving on, it's no slouch when it comes to growth. It's 3M rates of 57. That's a little bit better than average. That's okay. At the end of the day, this company doesn't have to be a growth powerhouse. We like it to be in the top half for sure. We like it to be a growing company, but we're not necessarily looking for blockbuster growth here. We're looking for good, consistent, reliable dividends, and it delivers that. So I'm pretty happy with the 57 on growth, given what our objectives are here. Value, it's also middle of the pack. It's about a 52. Again, that's okay. It shows that the stock is neither cheap nor expensive. It's reasonably priced, at least relative to the rest of the market. That's fine. We're not necessarily looking to time this one. This is a long-term buy and hold, collect the dividends, just be happy. Moving on, momentum, it does rate pretty low here. It rates at 37 on momentum. Now, momentum's actually been fantastic over the last 12 months. This stock hit a bottom in March of last year, like most of the rest of the market, and it's really been trending higher ever since. The reason this stock rates low on momentum is it really got beaten up between 2018 and 2020. That kind of intermediate term momentum was awful. Like the company did hit a rough patch, and that really showed up in the stock price. Now, why did that happen? That's a longer story for another day. A lot of it had to do with expectations. The stock was too expensive in 2018. And what we've seen over the last couple of years is the price corrected. And so anyway, it hit bottom in 2020. It's been doing well ever since. So, the momentum score is not good, but that's why it had a rough patch a couple of years ago, and that's showing up in the numbers. And then finally, size. It is a large company. This is a company that's been around for well over a century. So it's not surprising that it doesn't rate particularly well on size. It rates a 3, in fact. So this is not a small cap. We're not going to get any sort of small cap bounce from it, but that's okay. What are we looking for here? Again, we're looking for a decent current dividend, and it pays about 3%. And we're looking for steady long-term dividend growth. And this company has absolutely delivered that over time. So there you go. That's an example of a Dividend Aristocrat in action. If you like this sort of theme, you like companies that have that long history of raising their dividends, check out that ETF, ticker symbol NOBL. That's the ProShares S&P 500 Dividend Aristocrats. The beauty of ETFs is that you can just buy the ETF and be done, or you can actually look under the hood. They're required by law to tell you what they own. So you can always pick and choose the stocks you like, because there are a few in the list that I'm not particularly fond of. Most I am, but you can do your own homework there if you'd like. Just pick apart the ETF, use that as a starting point. So that's going to finish us up for this week. Look forward to picking this up next week.